to ICICI Direct. We are in an exclusive conversation with Mr. Chintan Haria, Product Development and Strategy at ICICI Prudential Asset Management Limited, to discuss what makes gold ETF a compelling buy. Gold ETF has attracted 446 crore rupees in September 2021, and most believe this would continue to scale upward due to strong demand caused by the festive season. With the ongoing rally across global equities and apprehensions rising around valuations, gold, which is considered a safe haven, is of course further seeing some interest. Chintan, what are you making of all the excitement that's surrounding riskier assets right now? Global equity markets are at a record high. There is some apprehension around valuations, potentially some correction coming through. Do you think investors should continue to add to this asset class and continue to build on risk?
Yeah, so no doubt there is some euphoria which is building in globally. I wouldn't say in India we've still seen the kind of euphoria we saw in 2007 for all those who have seen 2007. But it's also in the case of India, a larger section of the population participating in equities now. So as you know, 1.5 crore Demat additions in the last 6 months, leading up to 7 crore Demat accounts today. It is a healthy sign as long as people are able to keep their asset allocation right. Now, you mentioned about people adding on to risk right now. If your savings are increasing and a certain portion of that savings are coming into equities, that's fine. But as we've seen in the past, every euphoria, every rally that happens gets in more investors. And when the turn happens, those investors, because of greed and fear, run away. So we need to be a bit more careful on the way we are investing. And that's where a sound asset allocation approach based on your risk profile will help you to tide through the volatility which will probably come in the next 2 years. We can't avoid volatility in equity markets or riskier markets, especially after the kind of rally that we've seen in the last 18 months.
And of course, with central banks in the US, commentary is, of course, indicating that correction really could be closer than we'd like. But let's talk about asset allocation. Let's talk about gold. That really is a safe haven asset. The first half of this year saw aggressive outflows. Gold prices also were being watched, with the US dollar, treasury yields. So lots of factors really playing out in the case of the yellow metal. What is the view going ahead for the short term and, of course, for the long term as well on gold specifically?
So let's look at gold not in isolation, but relative to all other asset classes. We already spoke that equities globally have seen a massive rally. In fact, if I look at the market capitalization of equities itself, what was about $60-65 trillion back in March 2020 has already gone above $110 trillion as we speak. So in the equity markets alone, about $45 trillion of additional wealth has been created in the last 18 months. That's on equity. If you look at commodities, be it aluminium, copper, zinc, they are probably at their life highs or near their life highs. If you look at debt markets, the interest rates are low and they are probably the lowest that they have been in the last 10-15 years. They are inching up, but they've been low. So all asset classes have given returns which have been phenomenal, be it debt, be it commodities, be it equities. Let's look at gold now. Gold, which was traditionally considered as a safe haven, because it is considered as a safe haven, the current environment of rally in equities, commodities, has probably led to lesser inflows into gold. And if you see the stock of gold today available globally, it's only about $11.5 trillion. That's the total gold available in the market. Compare the equity rise in the last 15 months or so, or 18 months, which is $45 trillion, just rise in equity, to the gold available globally, that is $11 trillion. And it is not available because I don't think you're going to sell your gold and my wife is surely not. So the availability of gold is not like out of thin air. Every year, gold mining can only probably add another 2-3% to the existing gold reserve. So gold, which has been a reserve for the last 5,000 years, will see probably circulation happening in terms of asset class churn eventually when there is volatility in the market. So for investors today, we strongly recommend that start building gold today, because every time that you wait for the asset class to perform and then you invest, you're probably taking away from your wealth creation journey. If you had waited, for example, in equity investing till today, you lost out in the last 15 months of rally, right? So don't wait. If an asset class had underperformed, invest in it, add to it, and I'm sure then over a period of time, gold will also add to the investors' returns because of inflation rearing up.
Well, Chintan, of course, people buy and invest in gold irrespective of age and income. And apart from the religious and cultural significance, the yellow metal really is considered to be a good investment option as it retains its value even during financial upheaval, right? But the debate over which form of gold now, physical, digital, SGB, ETF, is best unending, right? It really totally depends on the discretion of most people, I'd imagine. But in your opinion, how does gold ETF fare with other products offering gold exposure? What do you recommend investors to do?
So for sure, if you look at the traditional way of investing, be it through gold bars or gold jewelry, there are certain costs or expenses like making charges which add on to your cost. It has been a traditional way, of course, and that should continue. I mean, I have to buy jewelry for my wife. I have no choice. But as an investment allocation, we believe that through the sovereign gold bonds or the gold ETFs, these are the two choices which are good for the investors. The sovereign gold bonds, of course, those who have a longer term horizon, because after 8 years you don't have it's tax free capital gains in the hands of investors. That also adds a lot of value. And for those investors who are looking to actively manage their allocation towards gold, equity, and debt, and want to keep, want the ability to go in and out, probably the gold ETF is a more is a better route. And for those investors who do not have a demat and trading account, the gold fund of funds, which basically feed into the gold ETF, are also a good choice. So whether you have a demat account or you don't, you can actually participate in the gold ETF either through the gold ETF directly or through the gold fund of fund. And we firmly believe, and it's been my, let's say for the last 6 months to 8 months, I've been a firm believer that at least having 5 to 10% in gold, or at least incrementally investing your savings in gold in a meaningful manner, will help investors eventually over the next 24 months. A lot of happiness in investing is based on crystal gazing what will happen in the next 12 to 24 months. Because if I look at the past, it's very easy to invest in technology stocks. It's very easy to invest in commodity stocks. But the past generally does not repeat in the future. And you need to be careful of your asset allocation as well. So we are not saying get out of equity. All that we are saying is why not add to gold after it has underperformed significantly. August 2020, gold was 56,000 in India. Today we are getting it at 46,000. So in some sense, it's a Diwali discount. Make the most of it.
I will talk to you about that in a minute, but talking about asset allocation and adding gold, in your opinion, of course, I'm assuming most of it will depend on one's risk-taking ability, but what sort of exposure to gold as an asset class should one look at a portfolio level?
Sure. So I'll give probably a more rounded answer to this, not just about gold, but any investor, and most investors today, those who obviously are, let's say, evolved and have their own asset allocation plan ready, they can choose what suits them best. But for most investors, the following probably will help. Have about 50% of your portfolio in dynamic asset allocation funds, right? The balance advantage fund category is pretty popular. Everyone knows about it. The balance 50% you need to divide between three asset classes. One is international equities, one is debt for your liquidity requirements, and the other is gold. So I would say the balance 50%, you can divide it in a manner that you have about 20% in debt, about 10 to 15% in international equities, and 10 to 15% in gold. So that would be the, let's say, breakup. Given that gold is generally not part of your financial investments, you should start with at least 5% today and then build on it as you move along. And for those who are booking profits in equity, very clearly gold is a good destination to be in, apart from debt.
Right. Chintan, of course, usually at this time of the year, conversations around gold pick up a lot of steam, right? You've got festivities, wedding season, at a time when most people choose to buy physical gold, largely for consumption or wearability. But if you're looking at gold from an asset allocation perspective, I would imagine it has to be bought regularly and frequently in a more structured sort of manner, right? Disciplined rather. And to beat volatility in any asset class, one way to do it is to buy it regularly through an SIP. In your opinion, gold ETF, while it's an efficient way of investing, should this only be restricted to being bought during the festive season, or regular systematic buying is what you'd recommend?
So for all asset class investments, the simple theory should be for an investor, make X amount of money. I have my expenditure every month. What I make, what I spend, I have certain savings. Out of those savings, I will be basically allocating in that particular month certain amount to equity, certain amount to debt, certain amount to gold, right? You can do it through different ways. You can do it in one fund itself, let's say the multi-asset funds, or you basically divide it yourself if you are you want to do that. And hence, like you rightly mentioned, do not wait for a festival. It reminds me very symbolically of waiting for February to do your tax savings, right? So don't wait for a festival to invest in gold. Don't wait for February to do your tax savings if at all you are still using the Section 80C benefits. And in fact, do it regularly. And whenever you are, for example, if you're booking profits, say 4 months down the line, if in January you're booking profits, there may not be a festival at that point of time, but why not take that money and then allocate a certain portion to gold then as well? So don't wait for Diwali or Dhanteras to invest in gold. Gold ETFs are very efficient. You can invest in them all throughout the year. And also, of course, the gold fund of fund. And you do SIP or you buy it meaningfully on the exchange bit by bit. And that's the advantage, right? You don't need to have a lot of money. The good part is even 50 rupees, 100 rupees, 200 rupees, you can buy 1 to 5 units and you don't need to even go up, step out. Today, of course, we are all stepping out and the things are looking good on the COVID front. But even 12 months, 15 months back when we were probably sitting at home and working, it was very easy to accumulate gold. And that's probably also what is explaining the fact that what was a 3,500, 4,000 crore category in March 2020 or around that time has risen to about a 15,000 crore category from a gold mutual fund perspective.
Right. For our audience who are looking at investing in gold through gold ETFs, talk to us about the different investing strategies that an investor or a buyer can adopt using gold ETFs.
Yes. So, like I said, the first one is whatever you're saving, a certain allocation can be part of gold ETFs on a monthly basis, on a weekly basis, or as the case may be, you should invest in gold. Second is whenever you're looking at rebalancing your portfolio, and if you're moving out from equity, right? Gold can be a destination asset class for you. Yeah. And third and most important is there may be a time where you know that, okay, like my daughter is 9 years old and maybe by 25, I may need gold for her, 22, I may need gold for her, I may want to gift her on 18th birthday. So I don't want to put making charges for her today and make something which she may not use. I don't know whether she'll actually wear gold or not. As of now, she's interested. So 9 to 18, 9 years down the line, if I need gold for her, why not park it in gold ETFs, use that, sell the gold ETF when she's actually 18 years old and convert it into jewelry. So many people know, right, that there will be an X amount of years after which there is one marriage, there is a child who will probably be 18 years or 22 years you want to give. So you can plan that way also, and that is also a very good use case. That don't lock your money into jewelry or bullion because you have to take care of it also, right? I mean, not just the worry of the design being obsolete, but you actually have to take care. And why not give something which is brand new when your daughter actually turns 18 or when the marriage comes after 3-4 years? That's also a use case as we see, which is very strong. So invest in gold, which you want to have physically eventually, but today you can invest it via the gold ETFs. It's a very efficient way to do so. And it is tax efficient as well because you keep it for 3 years, you get the indexation benefit, and on that you pay only 20% taxation on your capital gain.
In fact, you're right. I think it's got to be more discipline in nature, not just ad hoc during the time of the year when there's Diwali or Dhanteras, or for that matter, even when someone's getting married. But always great talking to you, Chintan. Thanks for that perspective. That was everything you need to know about gold ETFs and why you should be considering buying this asset class right now. Thank you.
Thank you, Samina. Happy Diwali to all the viewers.
Happy Diwali to you as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.